Nvidia stock has had a lot of volatility lately. The stock has had a pretty massive run up to over $200 per share. It has basically peaked out at around $210 per share. Recently has pulled back to $180 per share, and now it's rebounding. This is a very interesting opportunity to invest in Nvidia. And in today's video, I'm going to live trade. I'm going to invest in Nvidia using the wheel strategy. I'm going to use some technical analysis and show you right now how I pick a strike price using the wheel strategy to sell a put option and begin the wheel strategy. Now, the reason why I like Nvidia and some of the strengths that the stock has is that Nvidia basically dominates the GPU and the AI accelerator market. Its architecture, Blackwell, and ecosystem gives it a significant advantage. Using the wheel strategy, the most important rule is you want a bullish stock that has good support and stability. You also really want to like the stock, because if you like the stock, it makes it a lot easier to invest in it. So take a look at the momentum that Nvidia has experienced in just the last 6 months. The stock has gone up from around $118, $119 per share in that area to currently sitting at $193. So over the next 6 months, I think the stock is going to experience something very similar, where it's going to have a bullish momentum streak with periods in between where the stock will pull back, give investors opportunities to get in. It'll come up, come down, come up, and come down. And that's basically the trend that I think that Nvidia will continue to follow. It's a pretty simple trend that Nvidia is following, and for a good reason, because again, it's a market leader. There is massive AI demands and tailwinds behind Nvidia, so more investors are going to invest in this company because it is a safe bet. With generative AI, cloud hyperscalers, data centers, and much more, the secular trend is strongly aligned with Nvidia's core business. Analysts expect capital expenditures in AI infrastructure to keep rising. So, what should you do? Well, in my opinion, not a financial advisor, and this isn't financial advice, but it's pretty clear to me that running the wheel strategy is probably going to produce really strong results. The reason you'd want to run the wheel strategy is it's a very simple way to generate income and be part of a really strong company. So check it out. The moving average right here is 184, and it's very, very stable. Right now, Nvidia is sitting in the middle of its Bollinger Band. It's not high. High would be around $209 per share. Low would be, somewhere around 173. We're right here at a very fair value for Nvidia. Now, the moving average of 184 would be about the average that Nvidia has traded at for the last 50 days. I believe that this is a good value for Nvidia. It means I don't have to be a genius and try to predict the stock in the short term. All I know is by selling a put option, I get cheaper value than the current stock value. So that's a really smart play. Selling out of the money options works. It's been working for a very, very long time. I worked at Goldman Sachs and I've done the research on this. So I've been doing this strategy for a very long time myself, and I've scaled my portfolio to 7 figures. But yeah, let's simply sell a put option on Nvidia. Let's go to Nvidia Trade Options, and I'm going to be selling a put. By the way, if you want to see me live trade, then I do that on my Monday and Wednesday calls. I open positions live. This is a fairly rare video that I put up on YouTube where I am live trading, but I do this every single Monday and Wednesday, so you can see, how I pick stocks, why I pick stocks, and you can follow along. That's the first link in the description. So let's go ahead and sell a put option. I'm going to go for the December traditional expiration. December 19 is the traditional expiry date. It's the third Friday of the month. So I'm going to open up a position to actually execute on this. So let's see. Nvidia is at 192. Again, the moving average is 184. So I'm going to go ahead and sell the 184 strike price. I'm going to expand this option right here. And let's take a look at some of these deltas, gamma, theta, and the Greeks. These are called the Greeks right here. The most important one being delta. So the delta is currently sitting at 0.34. And essentially, if I sell this put option, there's a 34% chance then Nvidia will go down to $184. That's what delta signifies. It signifies the chances that the option will go into the money. I also want to own Nvidia, so I really would not mind getting executed and assigned on this sell put position because I think they're going to have very strong earnings potential. With the upcoming Q3 results expected to be strong, there is going to be likely momentum in the stock. So if it ends up pulling down to this level, then that is a good thing for me. And the wheel strategy is very strong, and it takes advantage of volatility, and it produces income out of volatility. For example, if I sell this option right here, I am going to be getting $770 worth of premium. That's going to enter my account right away, and I'm going to be open on this position. My obligation is that If Nvidia were to go down to 184, I will get assigned. The implied volatility on this option is 48%, which is fairly high, but not super high. The volume is 79 and the open interest is 3,382. The bid-ask spread is absolutely amazing with just a $10 gap in between, which has now changed to $5 as I'm actively making this video. Now, what I'm going to do is I'm going to go click continue and I'm going to sell several put options here. I'm going to start the wheel strategy. Let's quickly take a look at this diagram, and this diagram shows you what selling a put option looks like. Selling a put option means, like let's say I go for the 190, even though I'm going to go for the 184, it means that I'm ready to buy the stock at this level. If the stock falls to this level, then I'm going to get assigned. If Nvidia stock goes up, well, I don't get assigned. If it goes sideways, I don't get assigned. Even if it goes slightly down, I will not get assigned. I'm only going to get assigned if it hits the strike price of 184 in the actual position that I'm executing right now. So I'm going to enter right here 5 contracts, and I'm going to execute on 5 contracts. It's going to bring me about $3,925 worth of premium. I'm going to enter for the bid, which is $785 per contract. And there we go. I'm going to submit this trade, and I just got filled and I collected $3,924.79. Let's real quick talk about the real cost and the real average cost of my position right now. Because just because I sold the 184 doesn't mean that my average cost is going to be 184. See, what's going to happen is, let's say that you sold a 245 put option on, some stock, right? Well, whatever premium that you collect, right? Let's say that you've collected $12 worth of premium, okay? Let's say you got $1,200 worth of premium, you sold a 245 put option. Well, you can subtract that from the strike price, right, to get your average cost, okay? So let's say here that I sold 245 minus 12 would be 233. Well, in our example, what I did was I sold the 184, but I collected 780, and that's why my break even here is going to be less. It's going to be sitting at $176 per share roughly. So if we go back here and look at the technical chart, $176 per share is actually very, very close to the bottom of the Bollinger Band. So this is why you don't have to be a genius in the stock market. You don't have to try to predict the future. You don't have to try to get lucky. You don't have to do tons of research. You just have to buy a high quality company and sell put options. And even if you get assigned, that's a good thing. In this situation, you can see how owning Nvidia stock would be a very big advantage at this price level. By selling a put option, you literally create yourself a paycheck and you get paid. Now, the next step to do is wait. And when you do get assigned, you go to the next step of the wheel strategy. The next step of the wheel strategy is basically this. Once you're assigned shares, you flip over and start selling covered calls. Covered calls are like renting out your shares for extra income. So you get to still hold on to the stock, but now by selling covered calls, you can bring in income. That oftentimes can be 3, 4, or 5% per month. Obviously, it ranges, and depending on volatility, it can be less or more. But it's also really nice because when you sell a covered call, you get the capital appreciation and the dividends of the stock. The strongest returns of running the wheel strategy actually comes from the covered call position. For example, let's say that we were already in Nvidia, so I just sold a 184 put, but let's just say that we had gotten assigned on Nvidia recently and we got assigned at $190 per share. Well, first of all, we'd be up money since Nvidia has recovered pretty well from the 180 level and it went to 192. So had we gotten assigned at 190 and the stock was below, now it's above at 192. But let me just show you. So if I go to sell call, let's say we had 100 shares of Nvidia right now, you would simply sell a call. Anything higher than your average cost is already a win. So if you got assigned at 190, well, we're already winning. So what strike price should you sell? Well, anything above is going to be winning. But how do you actually pick? Well, we will go back here and we would pick something that we believe the stock has some resistance at. Of course, Nvidia has massive resistance at $205 per share, but it also seems to have many resistance at 198. So if we were to go back here, what we can actually do is we can choose our break even to be at least 198. Now, as you can see here, all of these break evens are well above $200 per share, meaning that this position right here, running the wheel strategy on Nvidia, is a very easy way to profit. Right now, it's a very profitable trade to make, especially if Nvidia stays the same or goes up. So we can sell the 195 here. Now, let me explain to you what kind of return that you can expect here. So if you're selling a 195 covered call, that means that you still have room for upside. If your average cost is 190, well, we won't say that you got the premium because when you sell a 190, you still get premium. But let's just say the premium is all good. We won't count that for now. If you got assigned at 190 or your average cost is 190 and you sell a 195, well, first of all, you have $5 worth of upside. And second of all, you still get this $11. So 5 plus 11 would be $16 or $1,600. $1,600 on this position would be nearly a 10% return. That's very high for 30 days to expiration on an option. So literally in 5 weeks, you would make, well, what was it? Roughly 9%. It's not 10%, it's a bit less. But this is a very high return. Obviously, there is variance and the stock market is not predictable. If it were to go down, you would lose on this position. However, the wheel strategy is super strong because you can wait. You can still sell covered calls, and if the stock ends up going down, you still get the premium. So you have margin of safety, you have cushion, you have income. You have so many positives in this strategy, and it's the best strategy, in my opinion, to utilize in basically any market, especially an uncertain market like we're in right now. So again, let's quickly review the chart of how to run the wheel strategy on Nvidia, as well as some of the specifics, such as delta. I like going for about 30 to 35 delta, especially if I don't mind getting assigned. So step number 1 is sell a put option. You sell a put option on Nvidia and you wait. Once you're assigned, if the stock is below the strike price at expiration, you will have to buy 100 shares. Those 100 shares will be in your account on the following Monday after expiry. Once you're assigned, you sell covered calls. And when you sell a covered call at expiry, if the stock goes above your strike price, you'll be forced to sell 100 shares at your strike price, making money. So you will make money entering the stock, and then when you sell a call, you will make more income and get out of the stock. Once you're in and out of the stock, you've made the full circle, the full system of the wheel strategy, and you can repeat and start over again by selling put options. The wheel strategy works in multiple environments as well as bull markets, sideways markets, and bear markets. Let me explain. In a bull market, your put expires worthless. You get to collect the income, but you don't really have any covered calls because you never got assigned, which is completely okay. Now, even in a bull market, you may get assigned because plenty of times stocks pull back even in bull markets. There were so many times that Nvidia had pulled back even during the massive bull rise that it experienced. For example, basically from here, it doesn't look like a lot, but the stock pulled back from 136 down to 130. That's an opportunity. Right here, from 157 down to 152. So the stock comes down all the time by $5 or, give or take. So when you're selling put options at a 35 delta, about 35 out of 100 times you will get assigned. So even during a bull market, you will be assigned, which is basically a gift. Yes, that's right. I said that. It is a gift. It is a gift to get assigned on a put option on a high quality stock, especially in a bull market, because now you can sell covered calls and make a ton of money from covered calls, exactly as I showed you in the example. Now next is a sideways market. You can keep collecting premium every single day, well, really every single week, every single 2 weeks, whatever expiration that you pick. You can pick an expiry that's 1, 2, 4 weeks. I go up to even 45 days. So in a sideways market, nothing happens at all. You can actually see here from August basically to October, the stock has done nothing. So had you been selling puts to try to get in, you would not get assigned and you would just collect premium. And you would end up outperforming the market because the stock hasn't gone anywhere. Now, if you did get assigned, for example, on this pullback right here, the stock did go from 182 down to 167. And in this period of time, so many investors probably lost so much hope. But the truth is, this was just another buying opportunity. Had you bought the dip, you'd be in a very good position. And the nice thing is, when you do the wheel strategy, you get forced into buying 100 shares if it goes below your strike. So I keep hovering over this because the wheel strategy forces you to buy the stock. That is amazing. And then you do a covered call. So during this time, you are actually making money, although most stock investors have made no money at all. During bear markets, you will acquire a lot of shares and you'll be able to reduce your average cost. So you will be in this position very, very often, and then you'll have shares and you'll be selling call options. Now, this can be tricky because you will be fully invested, which is not a bad thing. I like being fully invested, when I am investing my portfolio, I want to be fully invested. So during a bear market, you will actually outperform significantly because most people that are buying stocks lose dollar for dollar, especially when the market goes down. Because when the stock goes down $1, they lose $1 per share that they have. But when you sell a put option, especially when it's out of the money, especially in a bear market, in a volatile environment, you can go lower on the delta. You can go for a delta that's 25 or even 20 and still make a lot of money because the implied volatility will be high. This number right here will be very high, right here. The implied volatility, it'll be higher. It'll be a lot higher. So you will be able to get paid a lot and actually make your portfolio more safe. You will have less drawdown risk because you're not owning stocks for whatever price they are. You're selling options, specifically put options, to get into a stock that's out of the money, and you're collecting premium. So you're going to save a lot of money in a bear market. This strategy actually underperforms in massive bull markets because when you sell a covered call, which is the second part of the wheel strategy, you are giving up some of the potential gains that the stock can make because you are limiting yourself through a covered call. So this strategy is actually safer than just owning stock because you're generating income, but you are letting go of upside. You're not fully letting go of upside. You can still make a very nice monthly return, but you're letting go of some upside if the stock were to skyrocket upward. The wheel strategy doesn't rely on guessing direction. It's about steady cash flow and compounding your wealth through using simple and safe methods by selling options. If you enjoyed this wheel strategy here, I do this all the time. I literally trade the wheel strategy basically in my portfolio consistently. So I'm going to be opening up a lot more wheel strategy trades. So if you have cash to work with, I recommend that you learn more about my coaching program and seeing all the live trades that I make. You will benefit significantly. Also, if you want to master the wheel strategy, I've made a very important long video on stock selection, managing the wheel strategy, getting in and out with many examples that you can watch on the screen right now.